As we mentioned, under half an hour now till the October CPI number. Investors waiting to see if the Fed has made additional progress in its fight against inflation. Joining us now with her market take, Citi Global Wealth's head of North America investments, Kristen Bitterly. What is that? Is that what you care about, Jay Powell and the Fed at this point, Kristen, or one of the things that you care about?
I think it's one of the things, and maybe what we could say is that the Fed's trajectory from here is the most important thing. It's not a question of how high any longer. It's really for how long are they going to hold rates at this level. And I think watching other signposts, CPI is certainly important. I think the most important part of CPI, though, is when you look at the composition of CPI, you have shelter at 35%. If you were to strip out that 35%, we're at the 2% target. And we all know that owners equivalent rents have a lag in terms of showing up in the data. So real time, we're seeing that number decelerate. We don't anticipate we're going to see it in the data yet. So I think like looking through to, is inflation continuing to cool and go in that trajectory, which means the Fed would be on hold.
Do you think that the recent move in the 10-year that emboldened the bulls to say, wow, there's some good things happening, is that going to be lasting, do you think? Or is it, are concerns about, the long end going up again and the, not being the Treasury not being able to sell anything over 5 years in length? Will that be a problem again? And I guess that depends on the somewhat on the CPI numbers today and next month.
I think there's some technical factors that are driving that, as well as some fundamental factors. So when we look at the technical factors, it is a function of, who is the natural buyer of the 10-year and everything that's transpired, as well as just the supply that is required in terms of meeting debt servicing, the additional supply that has continued to come to the market, and also just naturally, where are investors putting capital to work? Even our investors, when you're looking at the opportunities that exist within the fixed income market, you can get really attractive yields by going out 3 to 5 years. You can just kind of hang out within that intermediate term duration instead of stretching for duration and lock in some really attractive yields that are north of 6%, for example, on investment grade corporates. So I think we could continue to see volatility within the 10-year. But one thing that I will note is like history has told us that when you see a peak in Fed funds rate, that's also when you tend to see the peak in the 10-year as well.
Some people said that we talked to yesterday that the most recent bounce back that we've seen was kind of a nervous, non-committed bounce back, kind of a FOMO. I don't want to be out, but I don't want to really be in. Is that a good thing that people aren't embracing it to the point where the sentiment gets too bullish?
I think the sentiment, so overall, there's a lot of nervousness in the system, and I would agree with that. There's a lot of people that continue to be significantly overweight cash on the sidelines. And so I think you need to break down all of the major signs and what they're telling you. So if inflation continues to cool, if we see some cooling within the labor market, if we see that we've actually seen earnings trough, this quarter is going to be the first quarter that we've seen in over 3 quarters where we're actually pivoting now to earnings growth on a 12-month basis year over year. So you have a number of signs that a lot of the recessionary conditions, certainly from a profit standpoint, are behind us. And so you add that with that the Fed could be at the end of their trajectory. I think there's excellent opportunities to put capital to work both within the fixed income to lock in some of these yields, as well as the broadening out of the equity rally.
So will the Fed cut next year, Kristen?
I think so. Our view is one where will the data give them what they need within the first half of the year? Probably not. So I know there's a lot of disparity right now within market views as to when we will see the first Fed cut. I think the Fed ultimately is going to look at this trajectory of inflation, and they're going to look at the deterioration of the employment backdrop. And that's their mandate. So they have to look at those two things. And when they feel confident in seeing that through in the data is would anticipate that we would get our first rate cut, which will most likely probably be summer or second half of next year in our expectations.
And is anything going to break between now and then, do you think, that could bring it, make it happen sooner? Is there a recession next year?
I think the traditional recession that everyone was expecting is not something that we're going to experience because, as I mentioned, we already had the profits recession in terms of this financial tightening. We've already seen this interplay between services and manufacturing. When you look at the manufacturing data that we received recently, that is in contractionary territory and some of the lowest levels that we've seen since the 1990s. And so seeing this play out through the system, it's not in the traditional sense of everything all at once. And how asset prices react to that is also something that I think we have too much of an anchoring bias and even a recency bias when it comes to comparing everything to the financial crisis. A great data point that I read today is when you look at the past 9 recessions, home prices, for example, actually rose in 7 out of those 9. So I think in preparing your asset allocation and preparing your investments for where we see opportunities today based on entry points, both from an equity market valuation beyond that magnificent 7 in select pockets, as well as within fixed income and high quality locking in some of these yields, can help you navigate through a recessionary environment or just a slowing growth one.